Welcome back, friends. It's almost New Year's Day, and so I thought I would start the year off with a bang and talk about something a little bit more controversial. In this video, I'm going to talk about the problem with Bitcoin. Before we get started, if you are thinking about making any kind of investment, please go talk with a finance professional. No matter what town you live in, there is probably an accountant or a finance person who you can sit down with and have a conversation face to face about your investments. They can help you avoid making some silly money mistakes with your hard-earned money. But you didn't come here for a lecture. You came here to talk about Bitcoin. Now, this is going to be controversial, because I am not particularly a fan of Bitcoin. And there's a lot of people out there right now who are very passionate about Bitcoin. People have made a lot of money with Bitcoin, and there is a lot of emotion surrounding Bitcoin, and people have good reason for this. Over the last year, the value of Bitcoin has increased over 1,000%. And so there's a lot of people asking the question, what is going on with Bitcoin? So some of this is going to be my opinion, and you got to realize that there's people out there with different opinions on this. But I wanted to have a thoughtful conversation about the potential problems with what is going on right now with Bitcoin. So let's start by talking a little bit about how currencies work. There are countries all around the world, and each country has its own currency. Currencies are just like anything else, where their value is driven by supply and demand. But when we talk about currencies, supply and demand is being driven by underlying economic transactions. When people analyze currencies, they spend a lot of time studying economic activity and how money is flowing around the economy, because that drives supply and demand. For example, we can look at the US dollar, and we would try to understand the economic transactions driving supply and demand for the US dollar around the world. And then we can compare that against other currencies, like the euro for Europe, or the yen for Japan, or the British pound. The point is that actual people drive the value of currency through transactions in different places around the world. Then Bitcoin comes along. Bitcoin is a cryptocurrency. And the defining feature of Bitcoin is that Bitcoin is not associated with any government. This is one of the reasons people like Bitcoin so much. When you look at all of the other national currencies, governments actively manage the value of their currencies. Bitcoin avoids all of that. There is no government intervention into the value of Bitcoin. But that is also Bitcoin's greatest weakness. The point of money is that you eventually want to spend it. So the reason we all work so hard to accumulate money is that someday we want to use that money to buy something. So in the case of a normal currency, you can go to a map and you can point to a location on that map where people are trading and doing transactions in that currency. That's how normal currencies work. There's a physical location where people are using that currency. So let's say you have a bunch of US dollars. You know that if you go to the United States, you will be able to spend those US dollars. There will be stores where you can buy things in US dollars. You can buy food in restaurants using US dollars. There's a lot of businesses out there right now that are accepting Bitcoin. But the scary thing is, they don't have to. And there is no location that you can go and point to on a map where you're going to go there and find a community doing transactions in Bitcoin. Because Bitcoin, by its very design, is not associated with any governments. So I would argue that Bitcoin is not actually a currency. It functions more like a commodity. Commodities are raw materials, which you can buy and sell on a market. So they're things like gold or diamonds or soybeans or oil or anything like that. So rather than buy Bitcoin, if you really wanted to get around governments, you could just buy a commodity. You could buy gold and make all your transactions in gold, and you would get around any government. The main reason people do not use commodities for currency is because they are so volatile. And you want a currency to be stable. A stable currency is very important for a healthy economy. So just think about it. If you have money sitting in your bank account, you want the value of that money to be stable. You want to know your money is going to be worth relatively the same tomorrow, and the next day, and the next day. Commodity prices are always going up and down. They're volatile because of supply and demand. So let's look at soybeans. Let's say one year there was a bad soybean crop. Well, because of supply and demand, the prices are going to be very volatile. So you don't want to use soybeans as your currency. We see the same volatility in Bitcoin. But I don't want to take this comparison too far because there's a big difference between commodities and Bitcoin. Commodities are physically used in manufacturing processes. So people physically use gold in manufacturing. People physically use diamonds in manufacturing. So even if the prices dropped in the marketplace for these commodities, there would still be a demand out there for somebody who needed these materials for their manufacturing plant. The same is not true of Bitcoin. The underlying value of Bitcoin are the actual economic transactions that are happening in Bitcoin. But like we said before, since no government supports it, no one's actually required to do transactions in Bitcoin. So to understand this problem, let's talk through the doomsday scenario of Bitcoin. Bitcoin is volatile. Everybody can see that. And so somebody holding their money in Bitcoin might start to feel uncomfortable. And they're going to say to themselves, I don't like the value of my money going all over the place. Why don't I move my money into a stable currency where I know there is someplace I can go where I can spend it? That person can take all of their money and transfer it out of Bitcoin into another currency like US dollars or euros or any other currency. If enough people do this, the Bitcoin market will crash. If Bitcoin drops by 20% in value, people are going to start getting nervous, and that's when people start to run for the hills. And what you have to realize about markets is that if you're in a market and nobody wants to buy, the value of that market can drop to zero. You can lose everything. We already discussed that nobody has to use Bitcoin when there's other currencies out there. So if this scenario happens, it doesn't matter how many Bitcoins you have. No one is going to give you any money for them. We call this type of activity an asset bubble. Normal markets are based on value. So the reason why you buy an investment is because you think that somebody else will see value in that asset and buy it from you at a certain price. For example, you might go out and buy some equipment because you know of somebody who actually needs that equipment and will be willing to buy it from you at a certain price. So there's actual value being exchanged in this transaction. Asset bubbles happen when the price of the asset rises above the underlying value. We call this speculation. Speculation happens when people are trading solely on price rather than the value of the underlying asset. This usually occurs when a lot of people pile into a market and drive the prices up because of supply and demand. The problem with speculation is that you are buying an asset based solely on the idea that you are going to be able to find some other buyer out there who is willing to pay a higher price than you. The risk of this is that that buyer might not show up, and then you've bought something for more money than that item is actually worth. So let's say you have one investor who goes out and buys an asset. They sell it to another investor for more money. That second investor goes out and finds a third investor who is willing to pay even more money for the asset. But what happens if that third investor suddenly finds no buyers out there? That is what happens when asset bubbles burst. So let's conclude by talking about the problem with Bitcoin. The underlying value of economic transactions do not support the current market price of Bitcoin. If that is the case, that means there is speculation in the market creating an asset bubble. That creates risk. Like I said before, there are a lot of different opinions out there on this, so I want to hear from you. Go ahead and leave a comment down below. Let me know what you think. Are you passionate about Bitcoin, or do you think Bitcoin is problematic? Let me know. I just want to say thank you for watching. It's going to be a great year. I have a lot of exciting videos planned. The best way to supercharge a business is through accounting and corporate finance, and I release a new video every week. So come back and check out next week's video.